Welcome back. We are an hour away from the opening bell for a Monday, and we have a rally underway. Take a look at futures indicating a triple-digit move for the Dow Industrials ahead of a holiday-shortened trading week. The Dow right now up 330. That's 0.75%. The Nasdaq is up 170. That's also 0.75%. We are at the highs of the morning right now. Of course, we got jobs data out this week, and the markets are closed on Friday for Good Friday going into the Easter holiday. Still, markets are still in correction territory. The Dow, the S&P 500, the Nasdaq down about 7% since the beginning of this Iran conflict, which started on February 28th. Meanwhile, concerns are growing over private credit. Companies are talking about defaults ticking higher, links to banks and insurance companies raising some risks. Stocks are down better than 30% over the last 3 months within that sector. The Treasury reportedly moving to scrutinize the industry, planning talks with insurance regulators. Treasury Secretary Scott Bessent focused on risks around leverage, liquidity, and transparency. Officials aiming to contain any fallout as stress is building in the $2 trillion market for private credit. Joining me now is MacroMavens President Stephanie Pomboy. Stephanie, good to see you. Thank you so much for being here. And you made a point the other day when we talked, and you said, look, in periods of stress, people will sell what they can sell. And that is basically what we're seeing. You're going to sell wherever you have liquidity. That's exactly what Mike Milken said to me when I spoke with him last week, chairman of the Milken Institute. Watch this. What is your take about the current worry about private credit, gates going up, investors not able to take money out? How do you see things?
If you look at the major money managers, maybe 1, 2, maybe 5% of their assets are with individuals. Most of their responsibilities are insurance companies have 20, 30, 40-year liabilities promising you. Now, what are they going to invest in? They're not going to come in and out overnight. So my opinion is what you're seeing is people want liquidity now, and whether that proves to be a good decision or not in retro. But the financial markets are strong, and overall private credit is institutional investors loaning money to companies in the United States.
Stephanie Pomboy, your reaction and assessment of this issue.
Well, I guess I have a slightly less sanguine take on the market. I do believe that these private credit woes will continue to devolve, mostly because we haven't seen any relief on the interest rate front to suggest that they would dissipate. And I think the real issue, as you talked about, is that it's so illiquid. And, you know, a lot of this money is held by the big investors in the private credit space, have been pensions and insurers. So that's kind of sticky money. But I think that they still need, you know, the insurers still need the money with which to make the fixed rate payments on their annuities. Pension managers still need, you know, the money to pay out whatever retirees they've got that are on the books. So they do need the income stream that is not being thrown off. And, you know, in desperate times to raise liquidity, they're going to sell the liquid assets first. And so I think, you know, there's obvious potential for the stress in private credit to spill over into the public markets. In fact, I have long argued that the public markets will be flogged for the sins of the private credit space. And you're seeing that already. Junk is an obvious concern, but the less obvious and I think much more important concern is investment grade. I think a lot of people would be surprised to learn that the investment grade market, which is $9 trillion of the $12 trillion in total corporate debt out there, $9 trillion is investment grade. $5 trillion of that, so more than half, is BBB rated, which means that one downgrade renders all of that paper junk, and it becomes off limits to any fund managers that have, you know, quality mandates. If you're running an investment grade fund, all of a sudden you can't own $5 trillion or more than half of that market if that were to happen. So the potential here for substantial downgrades in investment grade to lead to a cascading effect in the corporate bond market strikes me as very real, especially as we face this maturity wall, which you and I have talked about forever. There's 1.1 trillion of paper that rolls this year and 4 trillion in paper that rolls in the 3 years after that. So there's no relief coming for these companies. And again, interest rates have remained stubbornly elevated. So I don't see what changes. And in fact, I think the stresses will continue to build here.
So the stresses in the private credit market will ripple into the public stock market, you believe, as we see commodities move higher. Do you still want to own hard assets? I mean, look where oil is this morning. It's up, but even with Brent hovering around $115 a barrel and a record monthly surge, and crude oil at $100, 92 cents a barrel, stocks are up. The Dow Industrial is up 346, and there's a story out of Bloomberg this morning that says that there were heavy short sales by hedge funds and disposals by systematic investors have increased the potential for a sharp swing higher for stocks in the event of a de-escalation in the Iran war. These hedge funds are looking like they're going to capitulate. What do you think?
Yeah, I mean, it's hard to get whipsawed with all these headlines from day to day, and that's what hedge fund guys do. They try to play the tape. That's not my game. Obviously, I have a much more long-term horizon here, and the longer oil prices remain elevated, the greater the risks, obviously, not just to the stock market, but the corporate credit market as well. So I continue to be bullish on hard assets relative to paper. The one thing that I have owned, and I'm very happy to have a position in, is volatility, because volatility has, not surprisingly, picked up dramatically, and I think that will continue. So as to the futures being up today, we'll see how long that lasts. But these headwinds between higher oil prices and higher interest rates continue to bluster. And until we see relief on those fronts, I continue to be cautious on both the outlook for equities and corporate credit, especially.
So what about gold, Stephanie? I mean, do you think gold resumes its uptrend after this most recent sell-off?
Well, I certainly do. I mean, I think that we saw, obviously, that gold got thrown out as one of the more liquid assets as well in this wind down, the de-risking that we saw over the last couple of weeks. We also had the Turkish central bank dumping an enormous amount of gold as they rushed to try to shore up the Turkish lira. So that was a huge impact as well. And you're seeing gold now start to recover its footing. I mean, I think long term here, again, the outlook for gold is incredibly bullish. Central banks are accumulating it, but also we're entering a period here where I think it's just a question of time before the global central banks tilt toward monetary accommodation, be it especially in Japan. Here in the U.S., obviously, we're teeing that up, hopefully in May. And I think, the European and British central banks will follow. So I think we're setting up for monetary stimulus, which is always super bullish for gold as well, and hard assets more broadly.
And we had on Mickey Bowman the other day, and she said she's still expecting 3 rate cuts from the Fed this year. So we'll see about that.
I saw that.
Stephanie, great to see you. Thanks so much.
Thanks,
Stephanie
Maria.
Pomboy. We'll be right back.